Hey everyone, I just did a video, this is part 2, which is that $7.4 trillion of money is in money market funds. And I just did a video of why I believe the price of Bitcoin will be substantially higher than $95,000 because it solves a real problem real people have, which is that their US dollars that they own are like melting ice cubes. They are losing between 4% and 9% of their value every year. And that is not what money is supposed to do. Money is supposed to preserve its value so that your time and energy buys you more in the future than it does now. That's what money is supposed to do. And the US dollar doesn't do that. It loses between 4% and 9% per year. And on years with high inflation, it loses double digits per year. So I ended the last video by saying, you may be thinking that doesn't apply to you because you are storing your wealth in other places, like your house or stocks or bonds or real estate or something like that. But each of those has a serious problem, which is that more of them can be made. Every company that has stock can issue more of its own stock out of thin air and sell it to the marketplace. Every company or country that issues debt can issue more bonds. Real estate, anybody can build more real estate, and the stock market, of course, represents all of those stocks and bonds and all of the other things you can trade. So the prices of a lot of those assets are very high right now, but I don't believe that's sustainable. So anybody who has their money in stocks and bonds and real estate and thinks, well, the great thing about stocks, bonds, and real estate is they always go up, that is the kind of thinking that preceded the 2008 recession. The reason the recession was as sort of bad as it was the government had printed a ton of money that had found its way into stocks, bonds, and real estate. That had pushed the prices of stocks, bonds, and real estate way up, which had led people for a significant period of time to believe that stocks, bonds, and real estate did not go down. Well, of course, they do go down because they can't go up any faster than companies get good at making money. So when you buy a stock or a bond or real estate, what you're paying for is the future value of that thing today. But if a company gets 1% better at making stuff every year, but the stock price goes up 5% every year, then at some point you've got 4% of the stock price every single year compounded on itself that represents value that's not really there. It's value that has essentially been baked into the stock, but is not reflected by the company's actual ability to make products or services. And what will eventually happen in each of those cases is each of those things will return eventually to its underlying fundamental value, which means regardless of how divorced Apple or Facebook or Google or Microsoft or Amazon or Tesla or any other company gets, if their stock price gets completely divorced from the underlying value of the company, which is based on its ability to make money, eventually there will be a massive reset when all of those assets get repriced back down to what they're actually worth. And that happens in a recession. And we have not had a big recession in the United States since 2008 and 2009, which has led a lot of people to believe, since it's been so long, that we just don't have recessions anymore. And of course, that is the kind of thinking that typically happens right before a massive recession. Now, I don't know when a massive recession is happening. Could start, well, technically, we just had a negative quarter of GDP growth, which is gross domestic product growth. So technically, we're halfway to a recession already, because a recession is defined as 2 back-to-back quarters of negative GDP growth. When your GDP growth is negative, that means rather than grow, your economy shrank. A negative number means you shrank. A positive number means you grew. And we already had 1 quarter of negative GDP growth, meaning the economy already shrank for 1 quarter. So if it shrinks for a second quarter, it means we're in a recession. Although, of course, they will just redefine what a recession means and claim that we're not in one. But regardless, at some point, the stock market and real estate and everything will go through an epic crash, and then everything will sort of return to its underlying value, and everybody will be standing there scratching their head thinking, wait, I spent all that time and energy putting my wealth and savings into stocks or bonds or real estate, and now they crashed, and what am I supposed to do now? So another place, which is the title of this video, that people are storing their wealth while they wait to buy something in the future is in money market funds. Money market funds are essentially like storing your money in cash, but they're really backed by government debt. And the government pays an interest rate for people to buy its debt. And so the banks pass some of that money on to you. So if the government is paying 4.5% interest for people to buy its debt and keep their dollars out of the economy, the banks will turn around and pay interest of, let's say, 4%. So if the government's giving them 4.5% and the banks are giving you 4%, that means every dollar the banks get 0.5% in order for facilitating that interaction. And when you do that for a large amount of money, you can make a lot of money doing that. Well, right now, money market funds have $7.4 trillion in them. That is a vast, insanely large number. So what does that mean? What that means is, of the entire money supply, of all the dollars that are in existence, people have decided to put, I think money market funds are counted in M2, and I think M2 is like, let's call it $22 trillion. So if you've got $22 trillion and 7 of that 22, let's round down to 21 to make the numbers even, that means roughly 1/3 of the M2 money supply is in money market funds. Again, I'm not sure that the math works exactly like that. Maybe there's other calculations and considerations. If so, that's fine. It's still a massive number, and it's still a very large percent, regardless of how you measure it. But anyway, $7.4 trillion are in money market funds. That means the government is paying people to keep $7.4 trillion not in stocks, bonds, and real estate directly, because all of the people who have that money in that $7.4 trillion are making a conscious decision to park their money in a money market fund rather than to park it in stocks or bonds or real estate or Bitcoin. And they're doing that because they, in my opinion, wisely understand that stocks and bonds and real estate have a lot of risk right now, and that the prices of a lot of those assets is really higher than is justified by the underlying fundamental value of those assets. So what's going to happen? Well, people are only parking their money in money market funds because they can make more than 4% interest. And a lot of people, when you tell them that they can either risk investing in the stock market with stocks or bonds, or they can invest in real estate, or they can just sit on the sidelines twiddling their thumbs and the government will pay them 4% interest, a lot of people, to the tune of $7.4 trillion, have decided to sit on the sidelines, twiddle their thumbs, make 4% interest from the government, and wait. Now, that is not sustainable. Why is that not sustainable? Because the economy is under such a mountain of debt right now, that the government cannot afford to keep interest rates high. Because if they keep interest rates high, that means the interest they have to pay on the $36 trillion of debt that the U.S. government owes. That means that the interest rate is completely unaffordable on that. And it means all of the companies and individuals that have debt are getting charged much higher interest rates as well, because the government right now sets interest rates for everybody. It should not. Interest rates should be set by the free market with just the laws of supply and demand. That would work much better, but that's not the way the U.S. system works. So interest rates in the United States are set by the Federal Reserve. They set the federal funds rate and some other key interest rates, and all the other interest rates sort of flow from that. So by high interest rates right now, they're making all of the debt in the United States unaffordable. And you can only do that so long before the system starts cracking. And what happens is, as soon as the system starts cracking, then all of the people, as they watch their 4% interest drop to 3.5, and then 3, and then 2.5, and then 2, and then 1.5, and then 1, and then 0.5, and eventually, like we had for quite a few years after the 2008 recession, I remember every time I stared at my Trustmark or my Wells Fargo bank account, it told me I was getting like 0.15% interest, like, 1/10 of 1% or 1.5 of 1%. I mean, some ridiculously, I think at one point it started with a 0, like your interest rate is like 0.015%. It was something ridiculously small. Like literally, regardless of what the balance was, my interest at the end of a quarter was like 4 cents. I mean, it was ridiculously low. So what happens when the government inevitably has to lower interest rates because all of the debt in the system starts cracking? And the answer is all of the people who have that $7.4 trillion in money market funds, they start to get antsy because they were happy at 4%. And the reason there is record high numbers in money market funds right now is because you can get 4%, or even I think 4.16% is the latest number. You can get a little more than 4% interest. Well, at a little more than 4% interest, a ton of people are willing to just park their money there and forget about it. Well, what happens when they're not willing to do that anymore? The answer is they have to find an asset. They have to do something with that money because they are now unhappy that they're getting 1% or 0.5% or even zero on that money when the government decides to stop just printing free money, when it stops offering that sort of free interest rate, high interest rate for them. So what happens is that 7.4 trillion gets antsy and it comes flooding back into the rest of the economy with those people looking for something that has yield, meaning something that goes up, something that will give them the kind of return they were hoping to get by doing nothing. And so that money ultimately flows back into other assets. And so at a time like that is typically when Bitcoin performs the best, because people are looking for some way to store their time and energy in a way that offsets at least some of inflation. And if inflation is between 4 and 7%, let's call it 7% that the government prints money out of thin air. If the if the inflation is 7% and you're getting 4%, at least a little more than half of inflation you're getting back in the form of interest. Now, you have to pay taxes on that, so it chops it back down a good ways, but still, you're at least getting something. Your inflation is being partially offset by your interest rate. But as soon as the Federal Reserve starts lowering interest rates, that goes away, and people start looking for things to park their money in that perform better than just the money losing US dollar. And times like that is when you see gold, which is already setting record highs, and Bitcoin typically shoot for the moon because people are looking for a place to store their time and energy. Now, does that mean that the only good time to invest in something like Bitcoin is when the Fed's about to print a bunch of money and people are about to get unhappy in money market funds? The answer is no, because a miniature version of that is happening all the time. All the time, the government is going through periods of bribing people into keeping their money on the sidelines with money market funds or repo or reverse repo facilities and all this complicated stuff that the Federal Reserve does and the Treasury does. And eventually, they can't keep interest rates high because of the debt burden that they've encouraged everyone to incur. And so they have to print more money. So I believe Bitcoin is always the best way to preserve your time and energy, always the best way to preserve your purchasing power. And as I always say, it goes up and down on its way up. I said the word up twice and the word down only once, so it's sort of 2 steps forward, 1 step back. It goes up and down on its way up. But in the long term, because Bitcoin is finite, because it is scarce, because there's only 21 million Bitcoin that will ever exist, it does not have the problem of inflation that the US dollar has. And it does not have the problem of stocks and bonds and real estate, which is all of those can be made more. Whoever controls each of those things can make more of them. And in each case, when you go a long period of time without a market correction, the market value of each of those things tends to get way out of whack, which is what I think is happening with stocks and bonds and real estate right now. I think the values of those that are assigned in US dollar terms are out of whack with their underlying value. If I did not think that was the case, if I thought stocks or bonds or real estate was a better investment than Bitcoin, then I would not be 100% Bitcoin right now. I would have an allocation to other assets. The reason I don't have an allocation to any other assets I should say liquid assets, things you can actually buy and sell on a daily basis, the reason I have zero allocation to stocks and bonds and real estate, other than, of course, I own my house, but that's not an investment. That's just so I can live in it. The reason I have no allocation to those things is because I think all of the stocks and bonds and real estate that I could invest in right now is massively overvalued. And there's nothing when I look around that I want to invest in. And I'm not alone. For example, Warren Buffett has a record more than $350 billion of cash that he's sitting on right now. He has consistently been selling off assets in his portfolio and just stockpiling cash. And he probably has a big chunk of that sitting in money market funds or something that's earning 4% interest or something like that. But the reason he's done that, he is arguably the best investor in the world for traditional assets, certainly not alternative assets like Bitcoin or gold or things like that, but for stocks and bonds and real estate and that sort of thing. Warren Buffett has a better track record than anyone else right now. Give me 1 second. Good evening. So even with his incredible track record of success for many decades now, he has decided there's nothing worth investing in for him right now. Not nothing, but the vast majority of things that he could invest in, he has decided are overvalued and he does not want to invest in them. So he's sitting on a record amounts of cash right now, just waiting for everything to crash so he can buy back in when everything's cheaper. And so the smart people, in my opinion, are doing what Warren Buffett's doing, which is they're pulling cash out of stocks and bonds and real estate and putting it in things that will perform well when the government prints a ton of money. And in my opinion, that is Bitcoin by a long shot. Now, gold is also performing very well, but I think long term, Bitcoin outcompetes gold and demonetizes gold, meaning I think Bitcoin sucks the value out of gold, and ultimately Bitcoin becomes the neutral reserve asset, monetary. So because that's my prediction as far as what happens with gold versus Bitcoin, I certainly think Bitcoin is a far better investment, which is why I have 100% of my liquid assets that I own or control are in Bitcoin as opposed to any other asset. So 7.4 trillion money market, $7.4 trillion. So 7.4 trillion is sitting in money market funds. I think a huge amount of that's going to flood back into the market when interest rates come down. A bunch of that is going to be looking for a home and will find a home in Bitcoin. And I think long-term, Bitcoin will outperform every other asset over the next 10 years. And that's all you can ask of any asset, is that it outperforms everything else. So I continue to think Bitcoin is a fantastic investment for all of those reasons and all the others I've covered in the past. Have a great evening, everyone. Thanks.